Our guest is bearish on oil and thinks that the global market will be heavily oversupplied throughout this year and well into 2026. We're joined by Vikas Dwivedi, global energy strategist at Macquarie Group. Thanks very much indeed for joining us.
Thanks for having me.
Could we start off with these Ukrainian attacks, though, on the Russian refineries? Does that not have the potential to cause a major change in sentiment when it comes to oil? I mean, if the Russian oil was cut off, that would distinctly tighten the market.
Yeah, it would. If the Ukrainian drone attacks reach the oil production or export infrastructure, it looks very different in the oil market. Instead of a pretty stark oversupply, you could lose 2 million barrels a day of Russian exports, and that would tighten the market significantly. And adding the geopolitical risk premium on top, oil would rally. We think in the range of $25 to $30 a barrel should that happen. So far, Ukraine has been hitting the downstream assets, right? The refineries. It doesn't have as big of a global impact. It does affect the downstream and certain refined products trades, but it doesn't affect the broader crude oil market as of yet.
Yes, and of course that would be a big step by Ukraine, wouldn't it? If they did something that would cause oil prices to shoot up, they might get pushback from Washington.
In a big way, there's been, we think, written and some unwritten agreements between the U.S., Europe, and the Ukrainians to, pursue their policies and agenda with respect to Russia, but don't knock out the upstream oil production or the export infrastructure. And if you've noticed, that's been largely the case.
Talk to us about your thesis that the oil market is oversupplied. We have a chart showing total OECD industry oil stockpiles, and they're almost 3 billion barrels right now. Of course, they spiked during COVID. Nobody was driving. Then they plunged. Right. They've been fairly flat over the past year or so.
Yeah, the OECD has been flat-ish, and that's a correct, I think, indicator that, a lot of the world and a lot of the generalist investors and traders have not been seeing builds in the oil inventory levels, but globally it has been building. You've had significant builds on the water. You've had significant builds in China. Actually, we estimate the onshore oil inventory builds have been somewhere between 95 and 98% in China. And so it's not as transparent as if it was in Europe or the US. So I think that is a mismatch. And maybe more importantly, when China is putting oil in storage, they're acting like a buyer, right? They're not just taking surplus barrels and storing them. They're buying those barrels for the purpose of storing, which is more like a demand barrel. And that's actually been helpful to the market, not falling faster than it currently has.
We're looking at oil now. It's holding above $61 today. You say that for fiscal 2026, you've now brought down your average WTI forecast to just $57 US. By fiscal 2026, do you mean calendar 2026?
That's correct. Yeah, calendar.
$57. So you really do see severe pressure on crude for the next while anyway.
Yeah, we do. Look, there is already signs of it. There's a tremendous growth in oil on the water. And, I think a lot of the skeptics of that will say it's a lot of Iranian and Russian and Venezuelan kind of distressed oil that just has to float until it can find a home. There is some truth to that. But in the end, that oil will arrive. There's timing issues that have also created some of the surplus. We think a lot of it is going to end up in onshore inventory, and that will matter. And the big sources of supply growth continue to be the U.S. Within the U.S., we'll have a big fourth quarter of oil production growth. Brazil is significantly ahead of most people's estimates for this year for production. Guyana, the North Sea, and then the big one is OPEC. We're frankly surprised at the skepticism in the market that the OPEC barrels aren't coming back. It is true they're not coming back at the advertised pace that OPEC themselves put out, but they're coming back, and you can see it from multi kind of dimensional ways. And we think it will create way too much inventory, and not just in the Chinese market or the Middle East. And we think it'll end up in the more visible areas like Cushing, Oklahoma, U.S. Gulf Coast, like Europe, where more of the marketplace can see the builds.
Vikas, we better take a break here. Thank you very much. We're out of time. Really appreciate it, though.
All right. Thank you.
Vikas Dwivedi is Global Energy Strategist at Macquarie Group.